What a week in crypto. Bitcoin is posting its best monthly performance in a year. The SEC just dropped one of its most significant regulatory announcements to date, and DeFi is dealing with a hack wave that nobody in the space can ignore. Let's get into it. This is Crypto in 5. Bitcoin came into this week with serious momentum. After months of grinding between $63,000 and $75,000 since early Feb, BTC broke out to the upside, briefly touching $79,388 on Wednesday before sellers stepped in just below the 80,000 resistance level. As of today, we're sitting around 77,000, and crucially, Bitcoin is now up over 13% in April alone, which puts it on track for its strongest monthly performance in a full year. So what's driving it? Two things worth watching. First, Tether's USDT stablecoin supply has surged to just under $150 billion, adding around $5 billion over the past 2 weeks. More stablecoin liquidity generally signals fresh capital entering the crypto ecosystem, and that's a bullish indicator. Second, and this is interesting, negative perpetual funding rates have persisted for roughly 47 days now. Most leveraged traders are still positioned short. That creates the conditions for what some analysts are calling most hated rally, where bearish traders are eventually forced to unwind, which can actually accelerate the move higher. That said, 80,000 has proven to be a serious ceiling for now. Whether BTC can break through will likely come down to the Fed's upcoming meeting. Market strategist Adam Heems from Tesseract Group noted that heavy institutional overhead supply sits just above 79,000. So a sustained break above that level needs to be driven by real institutional demand, not just short covering. And Michael Saylor has weighed in, declaring, "Winter is over." Some analysts are pushing back on whether the recent drawdown even qualified as a full crypto winter. But either way, the price action this month has been the strongest signal of recovery we've seen all year. Now, here's the story that's casting a shadow over all that bullishness. April 2026 has become the worst month for crypto hacks since the Bybit breach in February 2025. According to data from DeFi Llama, over 606 million was stolen across 12 separate incidents in just the first 18 days of the month. 2 attacks account for around 95% of that total. The 292 million KelpDAO breach and the 285 million Drift Protocol exploit. Together, these 2 incidents wiped out more in a matter of days than all Q1 combined, which itself totaled around 165 million. Broader trend here is alarming. DeFi recorded 47 separate hack incidents in the first 4.5 months of 26, compared to 28 over the same period. That's a 68% year-over-year increase in attack frequency, and it's not just smart contract bugs. We're seeing infrastructure attacks, social engineering, and even AI-driven attacks on wallets. The ripple effects are real. The KelpDAO exploit triggered over $10 billion in outflows from Aave across more than 20 connected protocols. Jeffries has warned that a string of high-profile hacks could temporarily slow Wall Street's appetite for DeFi tokenization projects, which is bad news given the momentum the sector had been building. If you're holding any DeFi positions right now, please review the protocols you're exposed to. Attack frequency is rising. Do your research. On the regulatory front, this week marked 1 year since Paul Atkins took the chair at the SEC, and he made sure everyone noticed. Speaking at the Economic Club of Washington, Atkins announced that the SEC is on the verge of releasing what he's calling the Innovation Exemption, a formal sandbox that would allow firms to trade tokenized securities on public blockchains and DeFi protocols for the first time under a structured regulatory framework. To put that in plain English, imagine trading tokenized Apple shares on a DeFi protocol with instant settlement, no broker, no 3-day wait. That's the kind of thing this exemption is designed to unlock. Atkins framed the SEC's new direction with the acronym ACT, Advance, Clarify, and Transform. The agency is officially moving away from regulation by enforcement, the model that defined Gary Gensler's era, and toward formal rulemaking and clearer classification of digital assets. The joint SEC and CFTC interpretive notice issued earlier this year already clarified that most crypto assets are not securities under federal law. That alone was a major shift. And separately, the UK's Financial Conduct Authority made headlines this week by carrying out its first ever joint crackdown on illegal peer-to-peer crypto trading across 8 premises in London, working alongside HMRC and the Southwest Regional Organised Crime Unit. Global regulators are moving. Picture in the US, at least, is looking more favourable for crypto than it has in years. So that's your week in crypto. Bitcoin is posting its strongest monthly performance in a year and knocking on 80 grand. DeFi is dealing with an unprecedented hack wave, 606 million and counting, and the SEC is entering a new crypto-friendly rulemaking era. As always, none of this is a financial advice, do your own research, but if you found it useful, a like and subscribe helps the channel more than you know. I'll see you soon.